So I hear this all the time. Now it's not a good time to buy. I'll just wait until rates drop back to 4% or 3%. But here's the thing. Nobody knows when or if that's going to happen. You can't time the market perfectly. Meanwhile, life doesn't stop. Maybe your family's outgrowing the place. Or your job is pulling you to a new city. You can't hit pause on life while you wait for the market to cooperate. Everyone's stressing over today's mortgage rates. But what if you could borrow around 4% in year 1, 5% in year 2, and then decide your best move in year 3? That's exactly what a 2-1 Buydown does. I'll break it down with a real $400,000 loan example so you'll know exactly how much you save and why it's a no-lose situation. Hi, I'm Lisa, a mortgage and finance pro. On this channel, I break down money, mortgages, and real estate that you're not taught in school. So, what is a 2-1 Buydown? Let's start simple. A 2-1 Buydown is a temporary interest rate reduction. The 2 means your rate is lower by 2% the first year. The 1 means it's lowered by 1% the second year. And by year 3, you're back to your original rate. Now, you don't just magically get this lower payment. The seller, builder, or sometimes lender funds the difference up front, kind of like a prepaid subsidy. It's a way to make your first couple of years more affordable. Okay, let's put numbers to this. Loan amount, $400,000. Actual mortgage rate, 6.3%. 30-year fixed loan. Without a buydown, your monthly principal and interest is about $2,478. Now let's see what happens with a 2-1 buydown. Year 1, rate is 4.3%. Payment is about $1,985. That's $493 less per month. Year 2, rate is 5.3%. Payment is about $2,219, and that's $259 less per month. Year 3 and beyond, back to 6.3%. Payment is around $2,478. So over the first 2 years, you save about $9,000 total in payments. And here's a key. The seller usually pays for this upfront as a part of the deal, meaning this isn't money you pay out of pocket. Most of the time, it's structured as a seller credit. For example, in our case, the cost of this buydown is around $9,000, the exact same as your savings. That money gets placed in an escrow account, and each month it's applied to buy down your payment difference. So you, as the buyer, get lower payments, and the seller gets their home sold faster. So it's a win-win. Now here's a question everyone asks. What happens after year 2 when your payment goes back to the full 6.3%? Let's look at the 3 possible scenarios. 1. Market stays the same. Rates are still around 6.3%. Your payment goes back to $2,478. You're not overpaying. You're just at the market rate. 2. Rates go higher. Let's say inflation pushes rates up to 7% or more. Now your 6.3% loan actually looks cheap compared to the market. You're paying less than the new buyers. 3. Rates drop. If rates fall below 6.3%, you've got the option to refinance into a lower rate and keep saving. So, no matter which way things go, you don't really lose. You either get normal payments, cheaper than market payments, or the chance to refinance lower. When does this make sense? A 2-1 buydown makes a ton of sense in a buyer's market. When sellers are motivated, instead of negotiating a $9,000 price cut, you could negotiate for a 2-1 buydown credit. The price stays the same, but you get cash flow relief in the early years. Buying a home already comes with high upfront costs. And the first 2 years of lower payments give you some breathing room to adjust. It also makes sense if you're expecting your income to grow. or if you think you'll refinance when rates drop. Now, I want to talk about things to watch out for. Of course, it's not perfect. By year 3, your payment is back at the full 6.3%. You need to plan for that. Don't buy a home assuming you'll refinance before then. Always budget for the higher payment, so you're never caught off guard. You're probably thinking right now, so how do I ask a seller? If you're writing an offer, here's how you ask. Instead of saying, lower your price, you say, seller to provide a credit of $9,000 toward a temporary 2-1 buydown. Your lender and realtor can help structure it. That way, you don't come out of pocket, and the seller gets a smoother transaction. That's the 2-1 buydown in plain English. Lower payments for 2 years, 3 possible outcomes in year 3, and flexibility, no matter which way the market moves. The real key isn't predicting rates. It's asking yourself, can you actually afford monthly payment without being house poor? Because if you're stretching so thin that you're also signing up for a new car loan on top of it, that's not a smart move. Instead, focus on what payment fits your budget comfortably and learn mortgage hacks available right now to make it work. Rates will always move up and down, but your time, you don't get that back. The sooner you start, the sooner you're building equity instead of waiting on the sidelines. Still not sure if now's the right time for you? Drop your situation in the comments. If you found this helpful, hit that subscribe button and share this with someone who's house hunting right now. And if you want me to run your exact numbers, reach out. I'd love to help.